All right, Yield Nerds, episode 183 and the first episode in 2026. Thank you for your support. I am obviously pursuing a very unique strategy, planting money that grows on trees in front of the New York Stock Exchange. I'll tell you more about it. So let's get started. Thank you for 495 subscribers. If you're new to income investing, I suggest you start with the roadmap. That will walk you from the basics of yield investing to where we are today and more to come. Well, we have several specific playlists. Feel free to look at those as well. The most important thing to remember before you go any further is that I have no magical powers of prediction. So whatever you see here, please do your own checking. Well, I'll review the market temperature in my money tractor and compare how my portfolio is doing compared to the market. And I'll play my favorite game, the Yield Super Bowl, and tell you about my equity strategy, which I feel pretty good about. My portfolio is slowly growing. It used to be 0.5% equity and it is now up to 7.7% equity. So I'm continuously increasing my allocation. Although I would argue I'm doing it in a balanced fashion. So I do have a slight over allocation in industrials and practically nothing in utilities and consumer discretionary. And those are based on my risk reward calculations. But at the end of the day, the big moves that I'm making are all in the bond sector. I am moving out of treasuries. Treasuries used to be 75% of my allocation, and as yields have dropped, I am taking money out of treasuries, putting a small amount into equities. However, the bulk of my fixed income is moving into muni bonds and agency bonds, where the yields are far more attractive on a tax adjusted basis. And I have a smidgen on the corporate bonds, but I'm not increasing my allocation there. Well, the reason I do what I do is because of Yield Super Bowl, and I got to be careful about picking up some of those dollar bills from my tractor tires. But let me tell you about Yield Super Bowl. And before I go further, I'm going to once more repeat that I am not a wealth management advisor. This is not tax or investment advice, and I don't do politics or product pitching. So please do your own homework. Having said that, let me tell you my bond strategy. I have my own effective tax that I take into account. I live in Illinois. The state tax is 4.95%. If you buy a corporate bond, you have to pay the federal tax and you have to pay the state tax. And so for me to buy corporate bonds that beat the yield of the treasury, which is state tax free, on a pre-tax basis, the corporate bond will need to have a yield to maturity more than 5.6%. And if the coupon is not more than 4.7%, or the yield to maturity is not more than 5.6%, I will not buy corporate bonds. And as of now, those conditions are not met at a 10-year duration or longer, and that is why my corporate bond allocation is very low. I am better off holding other instruments, and that is what Yield Super Bowl is all about. The same with muni bonds. I have my minimums that the muni bond has to meet, and if it doesn't meet that, and I use the 10-year treasury as the benchmark, so do I want to own the 10-year treasury or do I want to own a 10-year muni? So I do that same calculation over and over again on a pre-tax basis, and I adjust what I want to do. The 10-year treasury trades at around 4.17%. If you can get a 10-year muni or even a 15-year muni that trades at 4.25%, that is a fabulous deal because the muni is federal tax free. That's what I try to do when I look at munis. The reality is, the last couple of weeks, the only ones I've been able to buy have been agency bonds. And, that is because of some of the stuff changing underneath, and I'll show you what that is. So if I hold steadfast and say I will only buy munis that pay 4.25 or more, if it is 10-year, pay 5% or more that are 20-year, and I refuse to pay above par because in a declining interest rate, munis will get called and they will get reissued. And even though there are some call costs, because it costs some money to call, there is something called a call premium. So if you are a muni, if you're a municipality and you're paying interest at 5%, but you can refinance at 4%, the savings in interest expenses far exceeds the call premium, as it is called, So a lot of munis, in my humble opinion, are going to get called. And so I'm very careful about buying munis. I do not buy them at or above par. And so I look for high coupons because they're tax free. And if they get called, hey, I'll take that too, and I'll take a nice little gain. But if they have an OID, there is an OID rule, and I'm going a little bit faster. I've covered this many times before. So if you have some unused OID, that is also tax free. I like that. I call that cha-ching. So if you can buy a muni below par with some unused OID, it is like a beautiful yield that comes there. And if they get called, you might get 7, 8%, almost all of it tax free if you play your game correctly. And here is the game, and here is the proof in the pudding. All of these are munis and or treasuries. All of them sell for a gain. So I'm not saying you should do it. I'm telling you how it has worked out for me. If a muni got called, I always made money. And that is the beauty of the strategy I'm pursuing. So now let's talk about treasuries. There is something rather dangerous, as the experts would say it, that is happening in the treasuries. Short-term rates are falling. This goes from September, October, December, and January now. And you can see in the short end, short-term rates are steadily falling. As a matter of fact, intermediate term rates are also steadily falling because the curve keeps dropping. But check out the long term. This fancy word for this is called bear steepening because the long end of the curve is the risk of holding the treasury for a long time. American treasuries are owned internationally. If foreign governments, if foreign nationals, foreign pension funds do not buy American long-term treasuries, then the yield goes up, which is another way to say the price goes down. Some of it is happening as we speak, and it might create an earthquake if it continues. But as of now, long-term treasuries are a raw deal. And so what that tells me is to not increase duration for treasuries. Where would I go if I can't buy treasuries? Well, I choose to go to munis and agency bonds. You do you. There is also another place I choose to go, and that is equities, but I'm very choosy about where I go. If any of you own bond ETFs, I feel very sorry for you because they are taking that direct hit from the long-term yields going up, aka long-term prices coming down, so their portfolio is sinking. Or what about yield superbowl? Yield superbowl is the pre-tax return by each duration for many kinds of instruments. And in the short run in August, treasuries were looking good. Agencies were good in the medium part of the curve and munis in the far, far end. And we started noticing, hey, there's something happening. The short end may be falling pretty soon. And if you could get a 10-year muni, that would be very sweet. And yes, I loaded up on those 10-year munis, and life went really nicely for me. In December, we noticed that agencies weren't a good deal. Munis held all the cards. And so we said, hey, you know what? The reason munis are holding all the cards is because if you had bought a muni, your price would have gone up. And meaning if you bought it for 99 cents on the dollar, it would be trading at 100 cents on the dollar. That is why I showed you all of those green dots. Those munis that got called, I started making gains. What about January 2026? It's a very interesting thing that you see here. Treasuries have fallen a lot, as we saw before, except in the long end where treasuries are showing some bear steepening. However, munis are showing a couple of spots where they have huge returns, well above treasuries. And whenever I see those kinds of inflection points, I go there to see if there is a deal that I can capitalize on. And so here is the 18-month muni. You can see that all of these mature roughly in the middle of 2027, 18 months from now. And look at these sweet, sweet coupons, 5%. And I thought, hey, somebody gives me 5% tax-free for 18 months. I will load up, give it to me. And small problem, look at the price. Every single one of them is trading above par. Here is the risk of buying an 18-month, a muni with 18 months left in its duration above par. If you are the municipality, if you're New Jersey, if you're Connecticut, if you're McAllister Academic in Arizona, or any of these, you're going to sit here and say, hey, it's not like when this muni matures, we're not going to issue any new debt. We know, you know, every municipality will need to issue more debt. And so they're going to say, well, I don't know what the interest rates will be in 2027, but I know that I can issue munis at 4% today. That's the prevailing rate, maybe 4.5%. And I can issue a 10-year at 4 or 4.25%. And so instead of waiting until 2027, this is the call premium concept I talked to you about. Any muni that is 5 years or left, I mean 5 years or less left in the duration, but paying a really high coupon has a huge incentive to be called and reissued. When they reissue it, they might reissue it in 2026 all the way until 2037. That is the same as waiting until it matures in 2027 and issuing a 10-year. And the municipality will say, I don't want to pay 5% coupon between now and 2027. I'll save a lot of money, and they will be right. So be careful about buying munis above par just because the coupon is very juicy. I stay away from it. You do you. So here is what I am doing, although, you know, the pickings are becoming slimmer every day. I am getting out of treasuries, and these are the treasuries, they are less than 1 year, and I'm increasing duration only in munis and agency bonds as long as they meet the criteria. Outside of that, you can see in my credit ratings that I only buy the extremely nice investment grade munis and agency bonds, and the rest, these are T-bills with 30 days or 90 days. So pretty much, at least credit rating wise, if you believe the credit rating agencies, I buy superb quality debt. Now let's go to equities as money shoots through my exhaust. I got to put a bag there to catch all of it. I am indeed doing reasonably well. You may remember I was over allocated to gold, I was over allocated to AI, and when the market turned and when there was a market crash, I lost a lot of ground right around October. And when gold crashed, I kind of took a big hit, and that was an interesting lesson for me. It took a long time for me, but hey, December 15th, I have recovered. And so for 60 days, I was trailing the NASDAQ, and now I am back to take a commanding lead over the NASDAQ. So on a 3-month period, I am approximately twice as good as the NASDAQ. On a 2-month period comparison between November and January, I am almost 3 times as good as the NASDAQ. And on a 1-month period, I am 4 times better than the NASDAQ. So I would like to say I've figured something out. Now, I don't know if that is true or not, but my algorithm, I've kind of figured out how to use it wisely. I still use that algorithm at that website, and you can look at the previous episode for a detailed walkthrough of how to use it. And so what holdings do I have? Clearly, the money tree is producing dollar bills that I'm harvesting here. I do have some duds, but my duds are a very short list. And some of these are still waking up and going to the positive side. Cal-Maine Foods is the worst punch in my face. Cal-Maine, what did you do to me? They missed their revenue estimates, but they beat their earnings. But their dividends are a sweet 7%, so I'm holding on to it. Outside of Cal-Maine, the rest are minuscule losses. However, on the gains side, I have some nice juicy gains that I'm sitting on. You can see pretty much in the top 10, most of it is an AI play or a pharma play. And then you get some of the industrials. So I have anything from 50% to 10%. And then we go from Liquidia, which is a very interesting company, in my opinion. You do your own math. They're coming out with a new drug that has $1 billion market, and they are eating market share of some existing players. And so I have a bunch of these again, but I have started investing in banks, regional banks, because as interest rates drop, my suspicion is that some of the regional banks will get bought out by the big dogs. And then I come all the way until Johnson and Johnson, which is on the negative side. So I don't own too many equities. I've kind of narrowed them down. But what I do have, I did start a couple of ETFs. One is to increase my income, SCHD, which only gives qualified dividends, which are taxed at long-term capital gains tax. So if you take their roughly 4% pre-tax and you add the 20%, because you, whatever your marginal tax rate is, or effective tax rate is, you would add it to that 20% on the long-term capital gains. So this 4% dividend may really be for you, assuming your marginal tax rate is 25%. I'm just using a simple example. Maybe it's 22%. You would then only pay 20% if you owned SCHD, so you get an extra 2%. So there are reasons to own SCHD, so I have an allocation for that. SOXX is the semiconductor ETF, which is on fire. Thank you. So my daily routine these days, I don't really sell too many equities. I just sit on them and wait for them to grow. I do increase my allocation now and then. I have a maximum holding amount per stock. So if it is X thousand dollars, even if that stock is soaring up, up and up, I do not put more money unless, I mean, it's not even unless it is below the maximum allocation. And so that is my way of not tying up all of my returns on one single ticker. My bond searches have been coming up empty, so I haven't really bought a lot of bonds, and I am worried about what is going to happen to US treasuries. Well, remember, no matter what you thought about the rest of the content here, even a broken clock is right twice a day. So stuff I say here may be completely wrong, and I'm trusting that you will do the homework. Thank you for watching Yield Nerd.